Treasury Department's attempt to lower yields not quite achieving its goal this week. Yields back to where they were before the intervention was announced, and actually are higher than they were a week ago. At what point could rates start to become a threat to the equity rally? Joining us now is Bernstein Private Wealth Management Senior Investment Strategist Roosevelt Bowman. Good to see you. Welcome.
Thank you for having me, Mike.
Let's just start right there. I mean, we have yields higher, maybe not at absolute levels that are threatening in particular, but I guess the why kind of matters if it's just kind of this voracious demand for new debt. And I guess at some point what it might mean for somebody with an equity portfolio.
For sure. And I think the why kind of comes down to two factors. Number one, you think about the inflationary pressures that are coming from the ongoing conflict in the Middle East and higher prices of oil. The other would be kind of what's the credibility in terms of both monetary and fiscal policy. I think part of the reason you saw that retracement in yields is that many investors kind of view that buyback announcement as having a beach ball in the pool, putting your hand on it. As soon as you move your hand, it goes right back up. And I think that's really the challenge for the fiscal policy right now, is that often when you're doing those sorts of measures, you're trying to buy time. And you're looking for other macro or monetary forces that are more powerful and durable to take over. Unfortunately, that buyback announcement didn't buy a whole lot of time. And now, the Treasury is kind of in a tough position. And
certainly part of the story, everyone keeps pointing to this, is just the private sector raising so much money for the AI build out in larger amounts and maybe for a longer duration than the market is immediately equipped to digest. How does that feed into the AI theme as a driver of equity returns, of earnings? I mean, we've had this fabulous run of earnings that supported the market. Now it's a matter of sustainability, I guess.
Right. I think that's where we've been speaking to clients about it being a multifaceted AI trade rather than this monolith. For sure, you can focus on those hyperscalers and kind of what's the return on investment of these big data center build outs. But we've been speaking to clients about diversifying into other parts of the AI trade, if you will. So we think about healthcare innovation and some of those companies that are using AI to forecast whether someone might have a heart attack or discover new antibodies that can be the foundation for medicine that has fewer side effects and greater efficacy. So that's, I think, one example of kind of moving away from just the producers and AI infrastructure in terms of the models, and more moving towards the effective end users of those models that can help improve the profitability in different sectors, whether it be healthcare or maybe even manufacturing as well.
And certainly, I mean, healthcare has been, kind of a big outperform in the last little while. Part of that is some biotech trial results and things like that. I guess more broadly, are you bracing for potentially a little bit of a risk-off moment in the markets, or do you feel as if we sort of have enough cushion behind us fundamentally?
Well, I think over the very short term, it's a pretty light week data-wise. Yeah. And so I think all eyes will be on Treasury still, and certainly some attention towards Jackson Hole. When you look at the title of the symposium, it really speaks to much more kind of wonky times. And some of the research papers I used to write at the New York Fed, and not a signal towards monetary policy. Fed Chair Warsh has talked about moving away from forward guidance anyway. So I do think at least over the next couple of trading sessions could be pretty calm. But as you move into the end of the year, that's where we're likely to see maybe this crossover point where inflation, headline inflation, is actually outpacing wage growth. And that would be the first time in 4 years that we've observed that. That would lead to slower consumption in the quarters ahead. So, for certainly we've been speaking to clients about and positioning them a bit more defensively, leaning into some of those consumer staples and healthcare that do well in a slowing economy.
And when it comes to bonds themselves, keep pointing out the market-based inflation expectations that are built into the Treasury curve are not particularly onerous. So you're almost, at least on paper, being compensated for buying fixed income around these levels. Does that make sense?
I think over the longer term it does. So you kind of think 2 to 4 quarters ahead, and mainly for two reasons. Number one, when you look at where yields have risen to, it's actually kind of over the past 6 weeks, it's in the face of weaker economic data. Yeah. We've seen data kind of come in below expectations. Often that kind of divergence resolves in itself in lower yields, right, where the economic data really drives. I think the other part of it, too, is, again, when you think about the wage picture, for sure, the current labor market picture looks fine and solid, but those kind of forward-looking indicators, online job postings, the quits rate, separations, that sort of leverage between the employer and the employee, beginning of the year, it was kind of back in the employee's corner, and now it's shifting more to the employer. And if you have those lower wages, or at least wage growth that's not keeping up with inflation, that's a pretty good setup for fixed income over the next 2 to 4 quarters.